This is very, very important. And you can only really understand it if you understand the psychology of bankers. Imagine that you're a director of a bank and you have got loans out to businesses in this environment. And you know that quite a number of the businesses which you have lent money to cannot handle higher interest rates because they are, we could be really blunt and say that they're zombie companies which you've been keeping going because you didn't want to write off your loans. They could be merely businesses which in better times thrive, but when they get a drop in sales, then immediately they start running into overdrafts. So when it comes to that sort of liquidity money, do you really want to provide liquidity into an economy which you can see is beginning to turn down because interest rates are going up? The answer is no. The other thing is that quite a lot of your activities, and particularly since the 1980s, have been increasing in the financial sphere. So you've got a lot of exposure to financial assets. Rising interest rates, what does it do to their values? So that's another area which you're probably going to try and cut back on. So this is a time to be very nervous. And if you were caught, let us say, with COVID, and of course, COVID completely unexpected. What happened? Everybody, their sales stopped, their cost continued, their borrowing increased. So, you suddenly find that you are over-leveraged in a market which suddenly is beginning to decline. Now that, for a banker, is a frightening position to be in. So what do you do as a director of the bank? You want to cut back as much as you can. And the thing that was interesting, and I can't remember whether this came up the last time we spoke, but Jamie Dimon, he said that 2 weeks ago, I likened the economy to being in a storm. I've upgraded that now. As far as I'm concerned, we are in a hurricane. Now that is the most senior commercial banker in the world, giving you a heads up that he is going to start contracting his balance sheet. Do not ignore that. And nor will all the cohort of bankers around the world. They will know exactly what he said. And if they hadn't already arrived at the same conclusion themselves, they have been told by Jamie Dimon that this situation is getting worse. Therefore, contract your balance sheets. It is inevitable. And this is the cycle of bank credit. We've had this ever since records really began. It was particularly violent in the first half of the 19th century. It smoothed out a bit after the 1844 Bank Charter Act, which was a major piece of legislation. Of course, this is the thing which led to the post-war slump. It led to the 1930s. This happens every 10 years on average. And we are now, 13, 14 years since the last slump, the last bank credit cycle downturn, which was essentially financial in nature, and that led to the Lehman failure. So, it's time we had another one, I'm afraid. And if you are a director of a bank, you will be very aware of all these dynamics, and you will feel very, very exposed. And furthermore, where you have counterparty risk to the Eurozone and the Japanese financial markets, you will know that your counterparties in those markets are even more highly leveraged than you are. It's an average of the G-SIBs average in the Eurozone is around about 20 times. The average in Japan is around about 21, 22 times. So, it's just incredible, the leverage in these foreign banks. And that's where the failure is likely to come from first. So what do? When it comes to everything, you just want to just batten down the hatches and to hell with it. If you're going to, just get your loans in as much as you can, cut your deposit base as much as you can, reduce that ratio of balance sheet assets to equity, and protect your shareholders.
Are we beginning to see in the actual data these deleveraging steps on behalf of the banks? Is that already beginning to appear in the data that you monitor?
It's only really evident in slowing down of the growth. I'm talking sort of worldwide rather than specifically. The slowing down in the growth of broad money supply, which is comprised basically of bank credit and everything which is slightly more liquid. So yes, we are seeing signs of it slowing down, but we haven't yet really got the signs that this is really going to crash. But I have no doubt that in my own mind that is the direction in which it's going.
So you would think that banks would tighten lending policies, meaning they'd be letting fewer loans, they'd be making fewer loans right now, given their concerns. You would think they would probably trying to call any loans that they could, right? Just so they're not having them out there. I guess this is the type of behavior that you're expecting to see a lot more of over the coming months, correct?
Yes, that's absolutely correct. In fact, you can see it already in the figures issued by NASDAQ on margin debt for financing financial positions or positions in financial assets. I mean, that has been contracting very sharply in recent months. So it's really sort of understanding, what makes people reduce their loan positions. I mean, basically, when you've got a really frothy market and everybody's bullish, it's not the people taking profits, because actually their psychology is we want more. Right. So, inevitably what happens at the top of a market like that, when the loan books start contracting, is that it is the banks driving it, not the punters. And obviously it's not a pure argument. I mean, there's a bit of both, obviously, but I would say that overwhelmingly the banks, the brokers would be pulling in loans rather than the reverse. And, so when you see, sort of positions beginning to go sour, I think that they would tend to act very, very quickly on the margin in order to try and close positions down. So it's an interesting question, because we tend to think of margin loans only really being on the bull tack, but we do know that hedge funds have been shorting it and have recently been squeezed, which is why the equity market has been so strong in the last month or 6 weeks. So, either way creates a loan situation which would be reflected in the NASDAQ figures. But by far the bigger determinant is the use which the public put on that money in terms of its use value. So to give you an example, if they decide to dump the currency completely in return for goods and services, then it becomes completely worthless, despite the changes in the quantity of money which may or may not happen. And I think that at some stage we are likely to see this played out in quite dramatic form. And the reason I say that is that when you get a very severe contraction of bank credit, it inevitably leads to banking failures. It is the job of a central bank to try and ensure that these banking failures do not happen and they do not impact on members of the public. So what you're going to see is the currencies being debauched in order to protect the financial system, if I can put it that way. And I've said this so many times until I'm blue in the face. The prime example of this was John Law in 1720 France, when he printed credit in order to buy support shares in his Mississippi venture. And it got to the stage where it no longer began to work. The shares sank despite that. But what happened was that he destroyed the currency in the process. And we have a similar situation today, where the central banks will try and keep the whole of the financial system going, which basically is not just keeping the banks open for business, but also stopping financial assets from sliding in value. And now that's going to require enough money printing to either destroy the currencies through quantity alone, or more likely, destroy the credibility of the fiat currencies that they issue in order to try and support markets. And that, I think, is really where we're going with this. We are in a situation where the major banks are very highly leveraged. And when that happens and things start deteriorating in terms of the outlook as far as bankers are concerned, then they start contracting their balance sheets. Now, the reason this matters is that GDP is actually it's driven by bank credit. It is the spending of bank credit. The amount of cash spent, because you've got two elements of credit in the economy in terms of circulating media. You've got dollar notes and coin, which are token coin. They're not real. They're not real coins. And you've got bank credit. And if you take out the overseas portion, and funnily enough, I was looking at the numbers this morning, you can pretty much halve the level of cash notes on the Fed's balance sheet as liabilities to arrive at a cash figure for the domestic US economy. Now, that being the case, then 5% of it is cash, 95% of it is bank credit. So what happens when you get a contraction of bank credit? GDP contracts. Now, bank credit feeds not just GDP, but it also feeds the financial sector, the exchange of financial assets, the ability to hold on to financial assets. So it does two very, very important things. But if we concentrate on the on GDP for the moment, a contraction in bank credit to take them back to more normal times, I think means that it should, in theory, mean that GDP contracts by something like $4, $5, maybe $6 trillion. Now, that's a massive hit. That's a massive hit. And that is without anything happening from abroad, because we've got systemic risks from abroad as well. So I think it's terribly important to understand what this GDP number is. It is not a reflection of economic performance, economic prospects, economic progress, whatever the Keynesians and the macroeconomists believe. It's not that. It is actually just the sum total of transactions funded through bank credit. And if you get a contraction of bank credit, you're going to get a contraction of nominal GDP, which, if it doesn't match, because it won't match because it is also contracting the financial sector. So that, I think, is the most important thing to understand. And what it means is that the slide in GDP, which we're only just beginning to see, is going to be considerably worse than anybody expects.